better than your currency. Splurging millions, buying houses like Monopoly. Fucking 9 to 5, man, the money is a joke to me. Buying cryptocurrency, my money in the privacy. I make it rain dollars, they watch me disappear. I'm so fly, man, I'ma need some land again.
Hey guys and girls, welcome to this week's episode of the No BS with Birchy podcast. I'm your host, Nathan Birch, and this is the show unraveling the truth to the facade of the 21st century. We're now exiting the matrix and waking up to motherfucking reality. And that, guys, I think in 2023, a lot of people will be waking up to motherfucking reality. I've talked about this for a long time. I actually had great laughs about this at the start of last year. A lot of people have been scared about interest rates. Interest rates, inflation, what's going on, the news, what's going to happen out there. Everyone's concerned about that. Today, I'm going to talk about two things only. I'm just going to be really clear on something. So last year, we saw interest rates rise from 10 basis points from about March last year all the way through, or March or May, whenever it went up, all the way through to now. They've gone up by 300 more basis points. So it's gone from 10 basis points to 310, which if you look at the scale of that, that's 31 times higher than what it was going back this time last year. So cash rates have gone up a lot. And a lot of people, I've been forecasting this. If you're new around here, I've been forecasting what's happening with interest rates, what's happening with cash rates for 13 years, 14 years publicly. I once got caught out. I fixed my interest rates at 8.65% because I was scared. Everyone was in my ears saying interest rates are going to go up to 20% and all this stuff. So I fixed them in, and pretty much the month after I fixed them in, interest rates went down to like 4%, 5%. And I thought to myself, I'm never going to get trapped with that ever again. And I wanted to know how they worked. And nowadays I've got more debt than most people in the country would have. And I need to know what happens with interest rates. I've got about 20 mil worth of debt. And if interest rates go up by 1%, I lose 200 grand a year. If they go down by 1%, I save 200 grand a year. So, it's important for me, and I just share my thoughts and insights on that with everybody. And I've been right for 11 years, 12 years. I said that we would see interest rates in 2018 go down to negative interest rates, which interest rates went down to 10 basis points, which was 0%. And that's not impacting or looking at the level of inflation that was on top of that. And people laughed at me at the time and said, Nathan, you're off your head. They're not going to go down. They're going to go up. Well, they went down. And I expected that they would go negative, but the system isn't designed, the banking system isn't designed to support negative interest rates at this point in time. I believe that there's been some tweaking in the back end of the banking system. It'll be like a Y2K bug moment. If you're not familiar with the Y2K bug, go research a bit about it. It's the year 2000 with the 1999 rolling over for the millennium. It would have caused the issues with computers. So interest rates haven't gone negative. I expected they would. Some people said, Nathan, you said interest rates are going down, but interest rates have gone up. I said that the maximum amount of interest rate that we could see before the system implodes would be a 0.5% increase, which would take us to 60 basis points. That's just calculating the amount of liquidity that's out there, the levers that are getting pulled, and just looking at household debt with what people could afford. Basically, if we look back 10 years ago, people used to own their cars. People don't own their cars anymore. They have loans on their cars. They have loans for food. You go into the shops, there's afterpay for dinner, there's afterpay for this. And it's like the world is just caught up on a debt-fueled binge party. And, that's the world that we live in. And it's mathematically impossible for, most of the economy. And I'm not just talking about, property here. If you think about people with $1 million, $2 million loans on their houses, they go up by 3% or whatever. That 3% on $1 million is 30 grand a year. How many people can't afford that 30 grand extra per year? They're going to have to stop spending money on coffees or whatever. So you have a trickle down economics just on that front. But most businesses have debt attached to them. So if we're looking at businesses and their interest rates have gone up so high, well then they're going to have to pass that cost. So literally what we're seeing now is inflation, which is being caused. It's not just inflation. The only thing that wasn't being inflated away beforehand was the debt that people had. But now we've got inflation on that debt, and it's causing many, many issues. And going back in May last year or March, whenever it was that interest rates started going up, I started laughing and I said, well, this is going to be fantastic. Push them up as high as that they can push them. And I'm excited to see that they've gone up to 310 basis points, because I didn't think that they could do it. And I can see that they've got a very big issue. And that's the topic that we're going to talk about today, is the issue that they've created. I said that we would see not just households go bankrupt, not that would see businesses go bankrupt, not that would see big corporations go bankrupt. I said that we'd start seeing countries going bankrupt. And if we look at the amount of debt that's out there, just take Australia, for example. It had no debt going back a few years ago, and now we've got over $1 trillion worth of debt. That debt is made up of treasury bonds. The treasury bonds were based on the cash rate back in whenever they were set. So if the government takes out their debt may be a 1-year bond, a 2-year bond, a 3-year bond, 10-year bond, whatever the bond term is what they're taking out. And there's two things about these bonds. So firstly, the bonds that have been taken out, whenever that debt needs to get rolled over, is the new bond that they're going to be acquiring. So looking at the bonds that have been done to get us to $1 trillion, that's been at 10 basis points, 50 basis points, 100 basis points, 150 basis points. But now, because cash rates have gone up and interest rates are going up everywhere, the bonds that are out there have gone up as well. So if we're sitting at a 400 basis point bond, and it used to be 50 basis points, that's nearly 10 times more that the government has to pay for their debt that they have. And I said that we'd start seeing the government starting to implode. And just read a little article here. This one, I just typed into Google to explain to you something here, but I just typed into Google $31 trillion in debt. So if you type in 31 trillion debt news, you'll see lots of articles that are out there about this debt. So this one here is just from New York Times. It goes on to read how the US government amassed $31 trillion in debt. So you've got to ask yourself, if the government created the money, then why are they into debt, and who are they in debt to, right? It's because the government doesn't create the money. And I've talked a lot about this over the years, that to have a good relationship with building wealth and building money out there, that you need to understand how the money works. You can't just go, I'm buying a property, and ignore the fact that how the property goes up in value or anything like that. So it's very important to have a good relationship with it. So the government does not make the money, the central banks do, and they print the money or the currency, and they buy up bonds, which is other people's debt. So the US government has amassed $31 trillion worth of debt, right? That's just what the government has amassed. It's not including what all the corporations, what all the Wall Street's done, what all the households have done. Just simply the government, to keep the government operating, has got itself into $31 trillion worth of debt. So imagine if we had $31 trillion worth of debt and the interest rate was, 0.5% beforehand, and now the interest rate is 4%, right? That's 7 times higher over what they were paying beforehand. They couldn't even afford whatever they were doing beforehand because the government had to take out this debt in the first place. They were bankrupt and insolvent. And this is just looking at the US debt, because all currencies are based off the US dollar. And I think it's important to make a reference to that. But every country is now into debt of trillions of dollars, and it was never like this beforehand. So basically, we're going to see the governments go bankrupt, or the governments be insolvent, or the governments default on their debt, whichever way you want to look at it, over the course of 2023, 2024, 2025. Really exciting. And I remember, if you remember going back, however long Trump was in, right? Like that was maybe 5 years, 6 years ago, whatever it was when he got elected in. I remember he was laughing at the time, and he said, and this is when you start knowing that these people, they're all just actors, right? You start seeing Trump come in, and he said something to the effect of, it's all Obama's fault. Obama and he had his hands going, right, like, oh, Obama, he's the best. He's terrible. He called us $20 trillion worth of debt. Under my government, I'll make sure that debt goes into a surplus. We'll eradicate that debt. No one's been better at managing debt than me because I'm Donald Trump, right? Remember he said that, and it was like $20 trillion worth of debt at the time. And he said he was going to remove the debt. But we've suddenly gone up in a period of 6 years, in the best economic period in our lives and all these sorts of things, we've gone up to $31 trillion worth of debt. So in a period of 6 years, we've gone up by 50% of the debt. If I don't have a log chart here or anything like that, but if you were to get out a chart and overlay the US government debt over the course of the last 20 years, 30 years, 50 years, you will see that that's becoming a hockey stick sort of version of itself, and the debt is just compounding upon itself. So when the government takes out debt, they have to take out enough debt to be able to service the interest and pay the interest of that debt. This debt is never getting repaid. Otherwise, it would have been repaid, and it can't be repaid because when they create the currency that they use, the dollars that we use, that debt, we need to allocate enough to be able to pay the interest. So it's constantly getting a bigger hole of debt. So let's go on to it. 2 decades of tax cuts, recessions, responses, and bipartisan spending fueled more borrowing, contributing to $25 trillion to the total of, and setting the stage for another federal showdown. Washington, America's debt is now 6 times what it was at the start of the 21st century. So there you go. It's now 6 times higher than what it was 20 years ago. Right? They can't pay this shit off. But now we've got high interest rates poured on top of what the government couldn't live off when it was a zero interest rate policy, right? It's the largest it's been compared with the size of the US economy since World War II, and is projected to grow at an average of about $1.3 trillion a year for the next decade. So they're saying, and they're forecasting, that we're at 31 trillion worth of debt. It's taken us 2 decades to get to 31 trillion worth of debt. And they're saying in the next decade that it's only going to go up by 1.3 trillion a year, which would be $13 trillion. Slap that on top. That means there'll be $44 trillion worth of debt. That, I put all my credibility on the line by saying this, and I'm very confident to do so, that it will not be 44 trillion in the year 2033, because by that point, the compounding effect of the debt that's owed will push that more closer to 60, 70, 80 trillion dollars worth of debt. But they're saying here $1.3 trillion a year. So imagine you owned a business and that business lost $1.3 trillion per year. You'd be sitting there going, well, something's fucking broken here. This ain't working, right? But anyway, that's just how the governments run. But just remembering that the government's getting the debt from the same place that the consumer's getting the debt, and the bonds that are being bought out there, the liquidity flows into certain markets. So here we are now with a showdown because the US debt is rolling over. They've got to refinance their $31 trillion worth of debt. They've got to get some more bonds. They've got to go and increase their loan limit. But the difference is today than what it was last time that happened. And I remember when Trump was in, that he closed government and all the postal services and stuff like that had stopped. And I thought that was weird. And I did a bit of research into understanding how that sort of stuff worked at the time. And I was like, hang on a second. And he had to renew his debt. And this Biden bloke has to renew his debt now too. But it's not their debt. It doesn't matter which actor you sit on the stage. The game is set. The game is rigged. There's bigger controlling influences in the government that we look at. And I don't want to get into too many conspiracy theories today, but when we look at the level of debt, you've got to sit there and go, okay, all the governments around the world are either going to default and go bankrupt, or they're going to have to reverse the course of monetary policy because there's going to be a big recession because these countries default on their debt. And my thought of it is, and I'm looking at the statistical data that's shown for me to be able to prognosticate what happens with interest rates for the last 20 years, and not the last 20 years, last 14 years or so since my interest rate saga happened, and I really took a vested interest in that. And that is showing me that we're going to start seeing a taper in monetary policy around the middle of 2023, which, is just my thought. It's just my opinion. Don't go make bets based upon that. But if we're looking at the level of debt that's out there, we're looking at the level of restriction of currency that's happening out there in the marketplace, and the pain that's going to be clogged up. It's a clogged up system. It's like it's ceased. There's no oil in the system anymore. Liquidity is evaporated overnight. We've got a liquidity crisis, which is very different to 2009, but not too dissimilar from 2009. When we had the global financial crisis, the GFC, it started in 2007, 8 and 9, those couple of years that were there. What happened in that period of time, you had some dodgy banks, some dodgy operators out there, some dodgy sectors of the market. The US, it was the property market, it was the subprime loan market, which were just all derivatives which were out there. It was $8 trillion worth of derivatives that screwed up the world at that point. Now each government has got $1 trillion here, $5 trillion there, 30 trillion there. The governments are in trillions of dollars of debt. So this time we're not going to see a bailout of companies and small businesses and stuff like that. We're going to need to see a bailout of the governments around the world. So we're going to start seeing the governments default and go bankrupt and insolvent, which are already insolvent. And they're going to need a bailout, which is very exciting. And if we look at the big property boom, everyone's like, oh, Sydney had a big property boom from 2010 to 2016, and then it stopped, and then it had another boom through Corona and all these sorts of things. What caused the boom of 2009, 2010? It was because we had a crisis on our hand, and then they put a solution, which was changing course of monetary policy. They reduced interest rates. They printed out a lot of money. They started a lot of debt strategies. So basically, the government took on debt to try and keep the system rolling, which has played part to the US debt, for example, being at $31 trillion now, because they've done things to try and stimulate the economy. But the problem now is that it's such a large beast that they need to put a lot more. They need to throw a lot more at the system to keep the oil, flowing through the system. And my bet on that is somewhere around June, July, that sort of period of this year, that we'll start seeing a reversal in all the policies that were made in 2022, because they're redundant. And from that point, we'll start seeing liquidity flow into the markets, and we'll start seeing booms in certain things. My view on this is that when they do reverse course of monetary policy, that this will cause a hyperinflation. I talked about a hyperinflation many times over. I'm not going to go into it today, but the cause of the hyperinflation will come from all the stimulus packages which are to be put out throughout this next crisis. We are already in a recession. We are already in a depression. They've printed over the recession. They've printed over the depression to try and hide it, but they can't control this. They can't control inflation. They can't control what's happening out there at the moment. And it's going to be evident once there's changed monetary policy that we're going to see a hyperinflation scenario occur, something like a hyperinflation scenario. One other thing to note is an inverted yield curve. So I'm just going to go and look at, pull up some numbers here for you guys. At the time of recording of this, as I'm recording this, it's late January 2023, sorry. I'm just going to go look up the US Treasury bonds at the moment. So I want you guys to understand what a inverted yield curve is. An inverted yield curve is basically, I'm just looking here at the bond. So the 3-month bond, the 2-year bond, the 5-year bond, the 10-year bond. Let's just look at those bonds there. So if you were to take the bond word out and go, I'm just going to call it a fixed term interest account, right? Everyone knows what a fixed term interest account is at the bank. And let's just assume you go to the bank and you put your money away. You've got, 50 grand and you put it in the bank, and you go to the bank and you say, I want to put it away to get a higher interest. The bank says, well, you put it away for 3 months, you'll get 1%. You put it away for 6 months, you get 1.25. You put it away for 12 months, you get 1.5%. You put it away for 5 years, you get 2%. You put it away for 10 years, you get 3%. That sort of gist. So the shorter you put the money in for, the shorter term bond that's out there, the lower the return that you would get. If you're going to lock your money away for 10 years or whatever, you're going to get a higher return on your investment. So that's what would happen in a fixed term account. If the bank said that you could put your money away for 3 months and you get 3%, and if you put your money away for 10 years, you only get 1%, you'd be like, well, I'll just put it away for 3 months and keep rolling over that debt. What would happen at that point is that all the money that would be used at the 10-year or the 5-year tail end of the system, there wouldn't be enough funds there because everyone would be opting for the smaller term. If we look at the Treasury bonds, basically a 10-year US Treasury bond is where interest rates sort of bounce off or sort of surround. And if you look at the shorter term, that's, they're different type of bonds. So I'm just having a look here. I'm trying to keep calling me, my phone never ends, but I'm looking at, I'm trying to keep my screen back here. So if we look at what's happening in the US bond market at the moment, 3 months Treasury bond is paying 4.5%, 4.53%. A 2-year Treasury bond is paying 4.21. So the 3-year is more than the 2-year. The 5-year Treasury bond is paying 3.262%. So that means that it's paying a lot less than everyone. So the yield, instead of going this way, is going this way, right? And that's where the death cross is, and that's where we're at. Before, as soon as they change the interest rates, that's what had happened. So what happens when you see an inverted yield curve? Every time that this has occurred, you're followed by a recession within 12 to 18 months of the inverted yield curve occurring. The inverted yield curve happened soon after monetary policy changed around the world last year. I think it was around May or June 2022 that the yield curve inverted, and it's just gotten deeper and deeper and deeper. And basically, it's a run on liquidity. The liquidity goes from the longer end of the market, because there's a lot of volatility, to the shorter end of the market. If people only have it locked away for 3 months, they can get their money out. So there's a credit crunch that's occurred. There's a liquidity issue that's right on our doorstep, and it's not really being talked about out there. Should that be of a cause of concern for you? Well, you've got to make that call whether you're going to be concerned. I'm very, very, very fucking optimistic by this, because the only way out for them is just to print more money. There's going to be winners and losers out of that. Winners will be the people that have assets. The losers will be the ones that have cash. At the moment, having cash is not a bad thing, just because volatility out there in the market and whatnot. But once the cheap currency starts flowing through the markets, everyone has access to cheap cash and cheap money, and they just go and spend it on stuff, and that's what caused inflation over the last 2 years. But they can't get away from what they've done in the last 2 years. They've printed so much money. I've been so optimistic, so excited by it, and what we're about to see is very different than what you see coming from the market. So, is it a cause for concern? Is it a cause to be excited? I'll leave that with you to make that decision. I'm very, very, very optimistic on this. If they don't fix this, you're going to have businesses go broke. You're going to have all the households that have got $1 million debt for a house that they've got to go to work for every day. The issue that we're going to have is, if they don't change the course of monetary policy, if they don't make liquidity flow through the system, is that business is going to go broke, people are going to lose their jobs, people can't afford their expenses that they've already got, the business can't afford their expenses, and certainly the government can't afford their expenses. Anything that gets affected on the ground level, the government's going to have to come and mop up, and they're going to have to take the debt on, and it's going to blow the government up. So someone's going to get shot in the head, and it's going to be the person that has the cash, and the debt just gets inflated or gets devalued and gets washed away. And probably just before I end today's podcast, if I look at my own position 20 years ago, 2023 will be 20 years of me investing into property. Just thought about it then, actually getting old. But 20 years of me investing in property, stuff that I was buying for 150 grand, 200 grand 20 years ago, worth $1 million now. The debt, I bought a property for 200. I've got a loan for 150 on it. The loan is still 150K, but the property is now worth $1 million. That debt of 150K at the time was a lot of money. It'd be like $1 million mortgage, but 150K debt now seems relevant. It's like you pay for it, you sell the car and pay for it, whatever the case may be. So the debt becomes relevant with inflation. So that's why I get so excited to see how these things sort of work. Wrapping up today's podcast, if you have any questions, have any comments, leave the comments below. Reach out to my team, 1300 367 925. Email us at admin@binvested.com.au. I've probably set everyone a little bit of homework. I'm trying to think of how I can make these things more interactive for people to have homework. But I think, if you don't understand a few of the terms that I talk about, bonds, inverted yield curves, the debt the governments take on, you won't be researching and finding that information by looking at most of the websites out there. The government websites are trying to play this stuff down, but do a lot of research, follow the rabbit holes, understand those terms, understand what's happening, understand how they work out there in the system. And secondly, do a bit of a stress test on your own personal position. Have a review of your position. Is there something you could be doing to improve your cash flow? Is there something you could be doing to improve your capital position? Is there something you should be doing to protect yourself going through the next market cycle you're going through? And sort of look and play like, yes, whatever your position looks like today, maybe forecast and prognosticate, 3 different scenarios. If you were to change something, if you were to sell something and buy something else, if you were to buy something else and increase your debt limit, if you were to increase your cash flow by doing this, change your position, because your position you have today isn't the position you had 2 years ago, 5 years ago, and it's not going to be the position you have in the next 3 years, 5 years, 10 years. If you know what's going to be around the corner economically, how can you prepare and what things can you do to make yourself stronger through that period? So I'll leave you with that. Make sure that you share this with your friends. If you like it, throw us a like and subscribe to us on the No BS with Birchy podcast on Spotify, Apple Play, Google Play. Find us on YouTube and on Facebook. We'll catch up soon.
Like Bilal said, man, we're stuck in the matrix. This my advice, don't care if you take it. The dollar about to die, soon to be hyperinflated. This my 2 cents, don't care if you save it. Joint be decentralized and you will see you been lied to the whole time, and it's the irony, cause they do the exact opposite. You become a slave to the system, enough your money, all they do is profit. There's no conspiracy theory, you better hear me. Crypto will set you free before the system does. I don't care if you do or you don't, but what I'm saying is the truth to the reason you choke. I've never been a failure, excuse my behavior. Keep talking, haters doing me a favor. They all tell lies, I know what they been telling you. I'm the opposite, the Donald Trump of Australia. It's amazing, here for the taking, my time is never wasted.